We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies.
What'd you do?
What?
Me. Gabe did like a vocals check before we started. So I started laughing.
Oh, man. All right, we're back. I'm here with life partners Dane McKinney and Trevor Howard. They're sharing a water bottle in the studio today. Such a beautiful thing. I call these guys my kids. It's so fun. It's so fun, the three of us being in here. Mike Nuss is not with us today.
And we still haven't found him. Please call us if you see him.
I was checking the jail roster this morning to see if maybe he got booked, but
we only saw his past mug
I
shots.
think we got to check tee times. Yeah, we saw previous mug shots.
Is he on the golf course right now?
Yes, he's golfing.
That is
right
not
now.
allowed.
No, it's unacceptable.
That it goes against Deal Junkie policy to go golfing on the day that we record this.
Unbelievable. There was a golf tournament. It's for charity, allegedly. Yeah, we'll see.
We will not forgive Mike. Well, if he comes back and he talks about the charity and how much money he raised,
that's true.
Maybe we'll forgive him.
That's true.
Okay, so we're back. We're going to talk deals. Did I just lose my mic?
No, you're good.
Okay. We're going to talk about deals. Yeah. Dane wants to pitch me on a deal.
Yeah. I have a deal that I like. We're being
discreet?
We're going to give a go, no-go by the end of this conversation on the deal is the goal.
Well, I was supposed to do this in the meeting later, so this is
do it right now.
Yeah.
Okay, so we're going to do it now.
Yeah,
Dane,
pitch you on it now.
So this is a common thing that we do. These guys go out, round up deals, and then they pitch them to me, and I give my wisdom.
Yeah, and then when Gabe doesn't like a deal that I really like, it scares me. And I have to figure out what's wrong with it. So
it's my job. Just like Mike said, it's my job to shit on your deal so that we can see. I'm not a great brake pedal, by the way, so I don't know that I'm the right guy for this job, but
I'll try.
You're
good at keeping us in our lane, though.
I like to see the whole picture.
Yeah.
And ask the questions of where it could go wrong.
Yeah. So I guess where do you want me to start on it, Trevor? The pitch normally goes location, so we're not going to be super descriptive on location.
It's a tertiary market, smaller town.
Smaller market. I think population of the town sits around the 10 to 20,000 range.
So very, very,
very small. Yeah, but
is it surrounded by a bigger town?
It's near a bigger town, and we have a good relationship with the property management company that would manage the property in that town. So
we do?
Yeah, so Mark knows some guys that started a company out there. Apparently they're Dawgs. They're friends from college. So I use the word Dawgs as, sorry, I don't know that everybody knows the way
they're ugly.
No, Dawgs in my mind means somebody who like works really hard, hustles. I got dog.
DAWG.
I think that's how or
DOWG.
Dog. Yeah.
Oh,
no,
I love that word. That's just if they smoke a lot of weed. It's DOWG. So they're not weed smokers. They're hardworking.
Yes. Yeah. Hardworking individuals. Christian individuals, actually. They went to Corbin with Mark.
They're not cage fighters. They're actual.
No.
They're good people.
No, good dogs. Yeah.
Good dog.
Yeah, as a dog.
Not
but
like a
anyway,
junkyard dog.
Hey, we digress. Yeah, so market's good in the sense that vacancy's low in this market.
What's the asset class?
It's mixed use.
What are the mixes?
Well, we got a good base of retail tenants, which Gabe likes now because you have that building.
Bottom floor?
Yep.
Well, I like it in the markets I'm in. I don't know that I like it in every market.
You're going to like it in this market.
Okay.
We can pitch it more later.
Yep.
And then it's got floors above it, multiple, not quite a tower. For those who didn't listen to that episode, Mike said it's 10 stories as a tower.
It's not a tower.
Yeah, it's not a tower.
The half tower.
Thank goodness. Yeah.
Is it an elevated building?
It sure is. Yeah. New elevator.
So old building but new elevator?
Old building, new elevator.
That sounds good. Okay.
Which is...
Did it always have an elevator and they just put a new one in, or did they add the elevator?
No, always had an elevator, put a new one in.
Okay.
Yeah. Which is good. And...
Elevators are really expensive. Did you know that?
That's what I heard.
To put them in and maintain them. I have one in our SMI office.
This is like a 100-year-old building, roughly, right?
It's old.
Oh, man. Yeah, no, it's older than that. I think it's like 100. It was built in the 18s.
Okay,
Yeah,
so it's an old building.
But 1800s?
It's been like fully redone twice. I believe.
Is it
Yeah.
unreinforced masonry?
No, reinforced
Okay.
concrete. And then there's some.
Are you sure the person you asked knew what you meant when you were asking?
Yeah, absolutely. Because they went down that road with the lender.
Okay.
Yeah.
I asked that for everyone listening. It's really hard to get a loan on an unreinforced brick building.
And what's the fix for a building like that if it is unreinforced?
You got to go in and reinforce it.
Which is what? What is that?
You told me it's not this, but my understanding is you got to go open up the walls, bring it in. You're going to kill space on the inside, and it's a very expensive, hard thing to do.
So what's interesting about this is the unreinforced masonry. So you got bricks that basically just got stacked on each other, and this is the old way of making buildings, right? The problem being is that over time the grout gets old, different things happen. That building's not quite as solid as it once was. And if there ever were an earthquake, which now that's the thing, is we live on the what is the
tectonic plate.
Yeah,
something fault line.
Yeah, what's it called? What's it called?
San Andreas fault line.
That's what I was gonna say, but I don't think that's what it is.
No,
I think that's from a movie that I watched.
That's in the California.
There is a San Andreas fault line.
Yeah,
but now I can't think. It's on the
whatever.
Tip of my tongue.
Yeah.
Anyway, there was an article that came out in the New Yorker like 10 or 15 years ago that said that
we're due.
Basically, everything west of I-5 was going to fall into the ocean at some point.
Oh.
I think it's called Pacific.
Sounds right. Who cares though? Keep going.
Okay. All right. Anyway, so what happens is you get an earthquake, and they don't want these brick buildings to fall onto the people in the street. They don't care about the people inside the building. So you don't have to reinforce the whole building. You just have to reinforce the face or the faces of the building that are street facing, so that they don't fall out onto the street.
In.
So, well, what they do basically is you go in and you put in big, giant metal bracing and concrete and all this stuff, and you build a frame on the inside of the street-facing wall that holds that wall, so that if there's an earthquake, the whole building may fall down.
Mm-hmm.
But that wall on the street is still going to be there. It's not going to fall on you. So if you're walking in front of the building during the earthquake, you're going to be all right. But if you're in the building, you're
not looking
okay.
good.
So the building's not this.
No,
continue.
But you're saying that the whole thing is reinforced.
Yes, correct. Whole thing is reinforced from the inside, but then it has the brick facade and appeal, which I like.
That's sexy. I like that classic style.
Yeah. It's a good looking building. It's downtown in the place that it is.
Is this like one of the largest buildings in this downtown?
It's a big one. Yeah. It's a big one.
Because it sounds like a very small town. It's not going to have very many buildings.
No. We would have to buy the rest of the town after we bought this one, just to ensure that this was a successful investment.
Now you already lost me.
There's a number of stories of multifamily above it, which I like. One of the stories needs to be like converted to multifamily, but it's not the conversion that you hate to think about. It's already set up to be multifamily, and the plumbing is already set up for that. It literally just hasn't been built out.
It's just unfinished.
But it's unfinished. That's a better way.
So it's framed.
Yeah.
Plumbing's there.
That is my understanding. So
what part of it doesn't have
drywall?
I don't think
flooring,
it has,
electrical.
Yeah, and then it's not. They don't have the finishes for a a residential unit.
And this is just so one floor is not producing income right now.
Correct. Yeah.
And so we could make it with our acumen, and we can get people in there and finish that. You feel like?
I believe so.
How are we going to get people so far away to go finish this for us?
What do you mean?
How are you going to find?
How are we going to find the workers,
force?
the contractors, and all that?
Oh no, that's Mark's job. Mark's awesome.
So Mark can do this anywhere? I thought he can only do it within our vicinity.
No, there's people who like working everywhere.
And he's just good at finding them.
Now. That's their job, yeah.
So the main thing, I mean, you don't have the infrastructure, so you don't have maybe the subs in that area.
No,
you need to hire a project manager for that. So you got to find the people to run the project.
Correct. You'll need the boots on the ground. So that is a key question, and we got to make sure the juice is worth the squeeze for Mark on that.
Other than the floor that's not generating income.
Yeah.
How much occupancy do you have in the retail and the other multifamily?
I want to say retail's fully occupied.
100%.
It was not when we originally looked at this deal, which was about a year and a half ago.
Do you know average per square footage lease rate the building?
I don't know average per square footage lease rate. I do know what their what their current net is, and I think there's room for upside on it. Well, there certainly is room for upside, and there's also definitely room to decrease expenses. They're currently running at of gross revenue, their management expense is 20%.
Whoa.
Why?
It's actually a little over 20%.
Why?
I have no idea. There's
You
two
didn't
line
ask
items
why?
on it. No, I'm
Does that include any maintenance?
So
Or is that
no,
just
no.
management?
No, that's
Is there
their-
an on-site?
that's
Do
their-
they have payroll?
They must have an on-site. Yeah, so
There's
that's
no
the
way
only,
you get to that unless you have a payroll.
they
must
have
have
to
an
have an on-site.
on-site, maybe
Correct.
an assistant manager.
Yeah.
Plus, they're paying off-site. I
Mhm.
mean, how do you get to 20%?
I have no idea. It's baffling. It's a lot of money towards management.
The only time I've ever seen a property hit 20% management would I won't say who the management company was, but it was not SMI. The owner had signed a 2.75% management contract, but at the bottom line they were paying over 20% in property management because that was only off-site management. Then they had
No way.
they had on-site payroll, they had a manager and an assistant manager, and then a bunch of other little charges that they were charging for, lease up fees and other things, and it was totaling about 21%.
That's absurd.
On a 2.75% management.
So to clarify, yeah, that's gross. To clarify for listeners, sometimes you can have a management fee that says it's 5%,
Yeah.
but in reality, all the money is
Yeah.
made on the
Yeah.
charges. For,
Read the fine print.
Yeah, yeah. So I think we could find some efficiencies there. Is the moral of the story with the management company that Mark has?
Dog management.
With the Dawgs. Yeah. So that would be good.
How much of the multifamily's leased up?
That is a good question. I know
You're not
where-
bringing a lot of information to the table
thought you were
here.
pitching me on it.
No,
I thought he
I
was
think.
pitching me on
Well,
the deal.
so here's the problem: is I don't know how they're measuring it based on like what's vacant and then what's unfinished.
You have a rent roll?
And so, yeah, I have a rent roll.
Did you look at it?
No, not yet.
Oh.
No.
He didn't look at the rent roll before he pitched me on it.
What do you mean?
Oh, it's happening.
I haven't. I'm not. There's steps to this. I don't have time. I get sent a Dropbox with 1,000 documents. I look at their P&Ls.
You only need one, the rent roll.
Once I see, no, I only need their P&L.
Well,
The rent roll on a building like that though is always funky, and then they have an explanation for why that unit isn't
but the
rented.
P&L's funky too if they got 20% management.
No, I know. I feel
I'd
like
rather
it's-
see the rent roll and figure out how we're going to run it
That's fair.
than see the. I mean, I want both.
No, that's fair.
Yeah, you really should have looked at both prior
So
to this moment.
people listening, here's a little pro tip.
Guys,
Here's a little Deal Junkies pro tip for you. When you're underwriting a deal, you only need two things. You need what we call a T12, which is a trailing 12-month income and expense statement. Sometimes it's called a P&L. Sometimes it's called a financial statement. So everybody calls it a cash flow. There's a million different things people call it. Ultimately, you just want the trailing 12 months of P&L, which we call T12. The other thing you really need is a current rent roll.
Mm-hmm.
With those two things, you can underwrite a deal.
I like the last 24 months, but
Well, of course you do. You probably want T36, and you want to
Trevor
go through
still
their
looks
bills.
at tax returns from
What-
2018.
On the back of the napkin. If you're
Yeah.
going to do back of the napkin to
Yeah.
see if you've got a deal, that's all you need to get started. So we teach our brokers, like when you're on the phone, somebody says, yeah, I might want to sell. That's how we know they might really want to sell, is when they share those two things with you.
Mm-hmm.
If somebody just goes, sure, bring me an offer, they know you're an idiot. And they're not going to believe your offer when they get it, because they're going to be like, how'd they get to their number? They don't even have my financials. So if somebody's telling you, sure, bring me an offer, but I'm not going to give you this information, they're effing with you.
Yeah. Yeah, that is true. So we got all that stuff. I really did. I did.
have you underwrote this deal?
Yeah.
Are we under
Yeah,
contract?
No.
Oh, okay.
No. Wait, there's a lot of steps to it. Which is why.
So you did look at the rent roll to underwrite it.
Yes. Yeah. I looked at the rent roll.
And there's a bunch of
however long
vacancies.
ago. Yeah. No. There's plenty of upside on it. Yeah. There's lots of upside on it.
I'm out.
And-
I don't like this deal.
I don't think you're.
Dane is too excited about it. I'm
No,
scared.
You liked it last time. You liked it a year and a half ago.
I looked at this a year and a half ago.
Yeah.
Oh, gee.
You almost bought it.
That's a cool thing about deals right now, is like deals we were looking at a year or two ago.
They're getting ripe.
They're getting better.
Mm.
The deals are getting better.
This one has gotten a
This is
lot better.
Other than the fact that there's no liquidity and it's really hard to borrow money right now, this is a great time to be a buyer. If you can find the money, if you can figure out your equity and your debt stack and you can go buy stuff right now, this is an absolutely fantastic time to be a buyer.
Prices are dropping. Cap rates are rising. Prices are
So what cap rate are we buying this at? Where can you take it to? Like, why do you like this? There's a bunch of, you can turn these offline units to online. There's currently units that could be online that are just not rented, or does that tell you something about the market? Like, why are these not rented?
I think part of it is the fact that it was under contract for as long as it was, and so
with somebody else. They failed?
Not yet.
They're still under contract.
Yes.
They think they're going to fail. So we're the backup?
No. We're the partner.
With the buyer who has it under contract?
Yeah.
Oh, they're bringing us into the deal.
Yeah.
Why would we partner versus just us buy it?
Because we're going to have to raise money for the deal, and that
partner has money.
They have money, and they already have hard earnest money in the deal.
So they've already tied the deal up. They got hard earnest money in.
Mm-hmm.
They have money to put down on it. Why would they want to bring us in?
Because they can't close it.
Why?
Because they were intending to close it with a refinance on another property.
That didn't go through.
So
they need us to raise the capital to do it? Debt and equity?
The only reason that we're partnering with them is so that they don't lose their earnest money and we can keep the terms of the current contract. And so...
Why don't we just give them their earnest money and have them assign it to us?
Because it's a lot of earnest money.
Oh, God. Yeah. What did they do?
Why do people do this? It's a lot of earnest money.
Why do people
do like $150,000?
Because he closes on deal. Yeah, I thought we weren't. Yeah,
that's not specific at all to a deal. It's $150,000 of earnest money. How does that tell anything about a deal?
I got a call yesterday from Logan, and he says, "Hey, I need you to write a check." Where he locked up a deal down in Southern Oregon. He's like, "We really want this deal." Okay, yeah, I can help. He goes, I go, "How much is the check?" He goes, "Well, they want $150,000 in earnest money, so I need $75,000." And I'm like, this whole thing about like trying to make your bank account get bigger, I realize it's never going to happen.
No.
Just in earnest money. I need $1 million liquid just in earnest money.
Is this for the fund? Yeah, that's my.
It might be. He wants to lock it up individually in case it might work for the fund, or we might just buy it individually.
You should start using the fund money for that rather than your personal, I would think.
If it's going to go into the fund will reimburse us for that.
Gotcha.
Mm-hmm. But $150,000, all I'm saying is that's a number that happens in earnest money.
Yeah.
It's here, and it's the other deal I'm doing yesterday.
Wait, so he does have money for us to finish the deal also as well? It sounds like he can't do that. You said he has money to partner with us on.
Oh, so that's the other side of it, is the refinance for the other property that he was intending to use to close this deal. He's got 2 weeks to close this thing, and he's months out.
How are we going to close it in 2 weeks? We're going to raise them.
No. We're restructuring the contract, but his refinance, it's for those who he's doing the refinance through HUD, and HUD loans take
They say they're 6 months, and they're more like a year plus.
If they tell you it's 6 months, that's a problem.
It's a lie.
Yeah, that's a problem, because they tell us 60 days and it's 90 days, but if they tell you 6 months, it's a year.
It is 100%.
For a different loan. I'm saying if an entity is telling you something.
I've seen it a couple of times. It's 9 to 12 months.
Yeah. So I think he's a year into it, and then it got reset. And so
this was for his refi, though.
Correct.
Not for this purchase.
Correct. And he was going to refinance, cash out refi to
use that money to buy this deal.
To fund this deal. Yeah. And so he'll have money in a year or something, but we don't need it. We really just want to have some money that's already raised. He'll be an LP. He's not a partner. He's just going to be an LP.
How did this come to you? How do you
I just talked to a lot of brokers.
We tried to buy this deal a while back.
Yeah. Yeah.
They went with this guy rather than us.
Oh, I see.
Yeah. And then
our competitor now becomes our partner.
Mm-hmm.
Yeah, and we could have closed it probably by now.
He's actually also a client. I've written a couple offers for him.
Wow.
Yeah. No, so he likes us. He knows of you, and then obviously of me. But everybody knows.
Well, yeah, because I'm on Deal Junkies.
Yeah.
Everybody knows.
Okay.
Yeah, so it's a funky one, but the basis on it is ridiculous. We're buying it at it would be at under $100 a square foot. Your GRM is, for the current price, is like 7.
So gross rent multiplier is really low. Meaning
really low,
that-
which is good.
which is a good thing.
Very good.
So we're buying it on a low multiple of the
Mhm.
gross rents, GRM.
Mm-hmm.
And it's an old building with a new elevator
Mm-hmm.
with a low cost basis.
What's the in-place cap rate?
In-place cap rate is, if you take it's
You're on
around
your
8.
numbers.
Oh, on my numbers? Well, on my numbers it would be like an 8.
We're buying an 8 cap with
Yeah.
upside.
Yeah.
I got a question. There's two-part question.
Okay.
Who lends money on old buildings in small towns?
Well, you actually already have a loan from the people who we would ask to get a loan from.
They know about the deal?
Yeah.
And they would do the deal?
Yeah.
Okay, second question. Who insures a 100-plus-year-old building in a small town?
Considering no one
Ooh.
insures a 1970 building in a big town.
Not looking good.
Yeah, insurance is tough right
So
now.
you're saying we can get a bank to lend money on it, which is hard, but you
Yeah.
can't get insurance.
No, so there is insurance, but there's, as they say, everything's for sale. There's a price for everything. They'll sell you an insurance policy.
Who the current
Well,
provider?
so great call by owner. He let the policy lapse because he was selling.
Ooh, oops. I was going to say we should leave him in the deal and
Yeah.
go on as other insured to his
Yep.
policy.
Yeah, should have. Give him one share.
So he lets it
$10
lapse,
a
and they
vic.
tell him he's got to get a whole new one.
And they're like, "Whoa,
they
dude!"
raise the rate double.
Yeah. Yeah. So I guess they hadn't looked at it, and then they looked at it again, and
He didn't really let it lapse because it was for sale.
No, he let it lapse because
He's
was
like,
under
oh,
contract.
we're getting ready to go.
He thought he was gonna. No, he let it lapse because he was closing. So that's another part of the issue right now,
Ooh.
and that's why he's letting the other guy continue down the road because he's close enough, and the dude is like, well, I don't know how to.
So why did
It's a
he
whole-
stop filling this thing if he still owns it? Why
so
he
so the
stopped
current,
operating the property?
The current buyer actually was helping manage
Lease it up?
Yeah, and so he kind of took it over.
And then he stopped leasing.
So
it
he's
up?
helped. No, he's helped on the retail side. As far as the residential side goes, part of that I believe is because the money to turn the units, and he was just like, well, the next buyer he'll do it, and so they got to the point where, he probably wasn't managing it perfectly. He would have to renovate some of the units, and he was just like, we're close.
Why is the seller selling?
He doesn't want to own the building anymore, and he lives in a different state. And so he just wants to roll it into something.
He's doing a 1031.
I believe so, yeah.
So we should find out what he really wants to do. So this has been under
Yeah.
contract for a year.
Yeah, we've got
the-
a lot of questions that need to be.
The buyer has gotten involved in the management of it. It sounds like the
Yeah.
asset management of it.
Yeah, buyer's
So,
awesome.
so seller, it sounds to me like they're doing a quality of life thing. They don't live.
Yeah, that's what
They
it
don't
is.
live close to the asset.
Yeah.
Older building.
It's just heavy. It's heavy operation.
Probably doesn't put a ton of money in his pocket. He'd
No.
rather use that equity somewhere else.
Yeah. Yeah. I mean, that's the.
How long
that's
has
a
he owned
classic
it?
Story. I want to say he bought it I want to say 15 years.
So this
He's
is
owned it a
this is a little bit of a different kind of a deal where we're coming into, but the where my brain always goes, and hopefully yours does too, is like Trevor said, what's the seller motivation and what are they trying to accomplish?
Yeah.
What we're always trying to do is figure out a way, how do we keep that seller in the deal? Somehow.
Yeah.
With carrying a note, carrying a first, whatever it takes to try to leave them in the deal.
Mhm.
I think is the first question you ask.
Best place to get money from.
Yeah.
Yeah.
They're motivated. They're motivated to sell that building. They're willing to take security on that building. Like the easiest place you can go back and borrow money from is the seller.
Mm-hmm.
So anyway,
That will happen in the conversation next week.
I bet you that this other buyer did not massage the deal the same way we would.
No, not at all. Yeah, that's not his MO.
He's more of a price guy.
Yeah. He's a heavy value add investor. He has a number of large, heavy value add projects in smaller markets all over the state. So that's been his thing. He raises money from kind of a group of investors and then just gets bank loans. So that's been his typical
So
strategy.
you couldn't raise any money on this deal from those
This
investors
time around.
because they don't like the deal?
No. I think that they're just tapped out because he's got a number of deals, and part of it is getting money out from that other deal that he's refinancing, and then part of it is money's just hard to find right now. There's a lot of sidelined money right now. So
So you're saying 8 cap with upside, small market, big building. You like the deal. You like the building.
Yeah.
You think there's a way for us to come in and leave the buyer in the deal rather than the seller, or maybe leave the buyer and the seller in the deal somehow.
Make it a party.
And we take over. We run the deal. We take control, and we go in and finish out that floor and boost rents or do whatever we got to do, lower expenses. And what's the hold period? What's the goal here? To hang on to this forever?
I think it's an eternity asset. Yeah.
You literally own this thing forever.
Till you die.
I mean, maybe until you find something else.
Because it's going to generate more in cash flow than it does in equity growth.
Yeah, I would think so.
So this is a cash flow play.
Yeah. And in small markets in Oregon, that's kind of the only place you can find a cash flow play.
It scares me. It scares me because even if we have dog management, I've never met these guys. I don't know if they're any good. We have to build an infrastructure around who's going to work on the building, which means we've got to find labor in a small market. It's older than shit, and you've got to insure it. You've got to find money for it. You got to raise money for it. I think it's.
You cannot imagine how excited Curly would be for this deal.
I think it is. Well, he would only be excited if the guy wanted to carry a note for 100%.
That's true.
And we run into the same problem of how's it going to be managed. I've even just going to Portland.
Yeah.
We've run into problems with other managers that we hired up there until finally now SMI has gone into Portland, and so I can manage it myself. But I had a really hard time finding good managers up in that market. So to get out, and I can drive to Portland in 40 minutes to an hour, depending on what time of day and which car I'm driving. And I can't get to where you're talking about probably in less than a few hours, it sounds like, if it's a small outlying market somewhere.
No.
So that makes it harder.
It does. No, I think so. And part of it's not the deal that everybody wants to. The deal that you want to own is the new construction garden style apartments in Austin, Texas.
Ooh.
Right?
Okay.
But that's not where we make all
that's
our money.
That's a forecast.
It's not where we make all our money. Yeah. So that's my view.
So why do you like this deal? Tell us why you like it.
The basis on it is insane.
So you're saying
the price per square foot and the rent multiplier on it is so good.
So when everything else is a 10, 12, 15 times multiplier.
This
is a 7 and you're going like,
yeah.
I love this. I
think it's below 7. Yeah. So I think you're at like a 6-ish on the GRM, which for the record, like, one, it's an exponential curve, and then two, there's new construction will be at like 20.
Yeah, like the first 10 deals I bought were like 5 or 6 times GRM.
Really?
Yeah. Well, that was heavy inflation in smaller markets. Yeah.
Some of them might have been 7 or 8, but everything was sub 10. And I was always taught that the standing kind of like back of the napkin everybody always used before I got in the business was a 10x gross rent multiplier. You just go like, whatever. If the rents are this times it times 10, and there you go. That's the value. But so we'd pick stuff up, and I didn't really understand cap rates too much back then. We were buying smaller stuff, which on smaller stuff a gross rent multiplier makes more sense than a cap rate does anyway. But yeah, you can. I mean, it still happens. And when you're buying, really what you're doing when you're buying at a sub 10 multiple is you're trying to buy for cash flow. You're usually in a market that's not going to get a huge amount of appreciation because you need that multiple. You need a 15 or 20 multiple to get that huge boost in equity.
Yeah.
So we veto this deal.
No, I want to look further.
Yeah.
I think Dane came unprepared.
I didn't know that I was pitching it right now. Yeah, it was easier with the laptop.
He was not. Yeah, we put him on the spot.
Yeah.
Dane is a lot smarter than he sounds in this episode, guys. Trust me.
I don't know if that's true.
You knew quite a bit about the deal.
Yeah,
he didn't even know where the rent roll
like
was
it.
at.
I don't like it for the same reason you guys like it. Well, I don't care about the rent roll. That's the other side of it. Why would I care about the rent roll if I know what the market vacancy is? I know that the retail's filled up, which does worry me. But the retail's full. I know that. And then I know what the market vacancy is for multifamily. And so if that's low enough,
that market seems pretty small to have statistics in that are accurate that you can rely on.
I don't think that that's true.
I think that's very true.
If you're close enough to a big market, I think that actually on the retail side of things, you might be better than what you guys are thinking. I think that the multifamily would scare me more than the retail, and multifamily shouldn't scare us because they probably can't build anything there. So we'd have to look at the total market dynamics. But the only two asset types that don't scare me are retail and multifamily. And I feel like if you're not overbuilt and there's not too much competition, in just about any market you can make money if you buy it right.
I agree with that. Yeah. No, and so back to that though, like that's why the rent roll matters to me, but it's low, and you need 30 data points to have an accurate statistical analysis. So it's like,
do you have 30
within one standard deviation? Yeah, there's plenty of people that live there. Did you know that?
He's throwing some BS out there.
No, it's true. Look it
he
up.
Looked it up.
Everybody listening.
He was looking
no,
at ChatGPT.
Hey, that's what you get for college. They actually learned that in college.
See, there are reasons to go to college.
The worst class ever, by the way, but I won't say who's the professor. He's a nice guy.
Just for this episode, it was worth you taking that class. So
I know.
Now I know you only need
that information has been challenged that he's throwing out.
Yeah,
there.
look it up on the internet, guys.
You only need 30 data points to get an accurate statistic with one deviation. What's the one deviation?
Within one standard deviation.
What does that mean? Within one standard deviation.
So one standard deviation is within 66%, and then the second.
He's talking about a bell curve.
Yeah.
And you have standard deviations and
yeah.
a bunch of math and stuff that doesn't matter.
Yeah.
Well, it does when you're the one analyzing the deals. Trevor just sells houses now, guys. He's not even a deal junkie anymore. I miss him. I wish he bought deals. I'm running this ad so I can sell more houses.
Yeah, every time I turn on Facebook, I see Trevor's face.
Oh my goodness. This is Trevor Howard. This is how he bought $40 billion worth of real estate. Listen into his free course. It's actually really good. No,
I think they're great.
I
ads.
love those things. Yeah,
I love them.
No, and it's real. It's not a. What do they call it? A spoof.
I don't know what you're talking about. I want to talk about more deals.
We have 30 minutes into the. I thought we were calling it.
No, I thought we were going to talk about some other deals.
You want to talk about other deals,
or just the market in general? What time is it? We can talk for a little bit longer.
I will say that it's been a very rough couple of years especially in real estate brokerage. It's been really hard to bring buyers and sellers together on price. It's been really hard to find lenders who are excited to lend and will lend at any level that's worth doing a deal at. Leverage has been low, and so a deal that you used to be able to do 25 or 30% down now may take 40 or 50% down, and on top of that, they want a deposit relationship. So I have a resentment against banks. I've had dozens of meetings with banks over the last couple of years, and I got the same speech from everybody that they wanted to be a relationship lender. And I started digging into more as to what that relationship was, and I realized this is kind of like our slideshow we talked about in the last episode, is that the relationship they wanted was for me to deposit a lot of money into the bank and then for them not to loan me any money or help me with anything when I needed it. And that's just not the kind of relationship I was looking for. And so there are a couple that are doing better than others that are more interested in my business. But it's been really, really difficult to put loans together, to put deals together. And so we were kind of on a hiatus. I didn't close any deals for probably close to a year. Just recently, I've closed a handful of deals, and we're now putting some other stuff under contract. So we're back in the game. For everybody that's wondering, like, are buyers coming back? At least me and my partners are, and we're pretty aggressive, active, investors, if that's what you want to call us. And so we're chasing deals again, and it feels I don't have 30 data points for you with one. Whatever you call it, deviation.
It's all made up.
I'm the one deviation. But the feeling is that we're starting to get back to doing deals. There are more listings coming out that seem to be more reasonably priced. There are more deals that have been out for a while that are sort of getting ripe to where the prices are coming down. I was negotiating a deal yesterday. I think just shy of 2 years ago, very small market. We were negotiating a deal at close to $10 million. I underwrote it again last night, and I told them to offer it $7 million. Now, we were probably a little rich on the 10. It might have only been worth 8.5 or 9, let's say. And maybe 7 today is lowballing, and maybe the number is still 7.5 or 8. I don't know. Maybe the delta is not as big as the way I'm saying it right now. But I think that before where we're trying to stretch and we had a bank trying to stretch and we weren't able to get that deal put together because rates started to go up and things started to change and they couldn't get it was a new project that hadn't been stabilized yet. We couldn't get there in time. It was a race to.
And that's still not stabilized, right?
No.
Does that concern you about the market? Is that management that's not? Because it's been over a year, and they still haven't stabilized it.
It doesn't concern me because, like what Dane just said, I manage in that market now, and my portfolio is full.
So what is their problem? Why are they
managers?
Well, it could be a combination of things. It could be bad property management. It could be bad asset management, which would be the owner or whoever.
But what are they doing that's bad? Like what specific? Can you see?
Well, they started off with really low rents, and they had a hard time filling it. We wanted the rents to be higher. We started saying, if we're going to buy it, we need you to achieve certain benchmarks, which they couldn't achieve. They have competition.
Is that because they're advertising it poorly, though, or like what are they doing?
I haven't gotten that far into the weeds, but I will say that it's a very small market, probably as small or smaller than what Dane was just talking about, the deal he's chasing. Very small, and it got overbuilt. I don't think long-term it's not overbuilt, but I just think a lot of inventory, like a lot of markets, we got too many deliveries all at once, and that had to get absorbed. Well, all the other new buildings in town are managed by SMI, and they're full. And so you could say it's better management. I really don't know if that's the case. It might be the location, which I don't think that's what it is. It might just be poor guidance from the owner as to what they want to do. I can't answer that question. It doesn't scare me, though. I know that I can offer the right concessions or the right rents. Now, if I close on this thing on Thanksgiving, I'm a little worried. And the reality of it is I'm not going to be able to close on it until it's stabilized. They're going to have to – no bank is going to loan you money until you're 90 to 95% occupied. Unless I did just close a deal for a client and they closed at 80% or 85%. So sometimes you'll get some exceptions. They just don't give you they'll do some sort of holdback on your loan to where you don't get all the money at closing. So if you're a really strong borrower on a really big property, sure, you might be able to close something once it's 80% occupied. But most of the time, 99% of the time, you're going to need to be at least 90 or 95% occupied before you can close. So from where they're at today to where they need to get to, they're probably a couple months away from getting there anyway. Over this summer, hopefully they can get it filled up, and then it usually needs to season for a few months. So we're probably talking about a 6-month escrow at best. So now I take possession beginning of next year, and if I get some people leaving or whatever, now I can go in and re-rent in the spring months. But, it's a creative deal. They came back to us, by the way. This is oftentimes I say, like, you got to put the energy out into the world and let the deals come to you. And so the energy that we put out is we're active buyers, we're aggressive, we have certain buying styles that we like to buy in. And if that fits for somebody, and they know that already, the brokers know that, the sellers out there know that, we've built a reputation so that these deals, when they come back up again and they decide, hey, suddenly they have motivation to sell, then they call us. And so we didn't. I had completely forgotten about this deal. I didn't even remember that it existed.
Too. When you brought it up, I was laughing.
And then it suddenly popped back up, and it's like, well, now the deal actually starts to make more sense.
I liked it at $7 million a lot.
Well, I think I don't think the seller's going to like it at that number. I don't know that we can put the deal together there, but I'm like you. I think that it trades pretty close to 7 today, maybe $7.5 million. And so we'll see. We'll see if it will. Just like I was saying, like buyers and sellers there's been a big delta between what they expected.
Did they build this thing themselves?
Mm-hmm.
And so do they have a loan coming due and all that stuff?
I don't know. I believe they might still be in their construction loan if it hasn't stabilized because they couldn't go to perm. Or maybe it was stabilized and then they lost some tenants or something. They want to go. Their motivation, I believe, is they want to go build more.
So they need to recapitalize.
So they need to recapitalize. And there's just not – here's the problem. When you're out doing deals in tertiary markets, to Dane's deal or the deal that I'm talking about right now, you always have to look to exit. And so like Dane, that's why I said, what's the hold pattern on this? What's the holding pattern? He says that's probably a forever hold. That's not a great plan. You should always have a backup plan of what if it's not a forever hold and we got to exit or we got to refi or we got to do whatever.
Yeah,
when you're in these smaller towns, like when things dry up, you can get a loan today in Portland. Of all the places people don't want to go to Portland, Portland's probably the best place in Oregon right now to get a bank to go give you a loan. But you go to these smaller markets, the further away you get from Portland or the further away you get from I-5, the harder it is to find a bank, the harder it is to find a buyer if you're selling.
So on that deal, we have to create enough equity where we can sell it at enough of a discount where it makes enough financial sense to someone coming in and buying it.
Ultimately, it sounds like a cash flow play on Dane's deal, and you just got to generate as much income out of it as possible.
But to exit, you have to sell it at enough of a discount where that cash flow is still there for a buyer to come in.
Yeah.
And makes sense.
We have to improve it enough for the next guy to still buy it at an 8
and hope that
for us to make money.
And rate. So here's the thing: the elephant in the living room is interest rates are what killed the market. This is the worst real estate market since the
commercial wise, not necessarily residential.
Yeah. Thank you. I think in commercial terms. So 5+ units. If you're talking to Trevor or Mike Nuss, who do a lot of work in the 1 to 4 unit space. They're residential specialists, and so
I'm just a specialist in all.
The only reason why you
Trevor does a lot of deals, guys. We're just roasting.
We're just roasting. The only reason why residential didn't get crushed is because we artificially locked up all the inventory with 2.5-3% money. And so people sit in homes that they don't sell, but that they otherwise would have sold. During the Great Recession, we had the opposite. We had people were stuck in their homes because they weren't worth what they owed on them. And so they didn't have any other choice. If they had to move, they became unintentional landlords. They had to rent those units out. And then when the market came back, they all dumped that inventory. Today is a much different problem. People could sell if they wanted to, but they don't want to move around because now, I trade my $1,500 payment for a $3,000 payment. I get the same house. There's no reason to do it. And so we've got the market locked up. So there's no inventory. That's what keeps the values up. Is supply and demand. There's not very much demand, but there's even less supply than there is demand. So from a transaction volume standpoint, even on the residential side, it's very, very, very low. These numbers that we're hitting nationally are even worse than what happened in the Great Recession. So if you're a real estate broker and you're listening to this and you're still a real estate broker and you haven't hung up your license to go back and work a job somewhere else, congratulations. I believe you've survived the worst of it, and I think we're going to come out of that. Now we're talking about rates we're already seeing rates start to come down. The Fed's talking about lowering rates. I think over the next year or two, you're going to see those interest rates recede. But in the commercial, what is a deal worth? Everybody says, well, the market dropped, 15, 20%, maybe 25, 30% in different asset types, maybe 40 or 50% in office, So different asset types got hit harder, but you look at a deal like what I'm chasing here, maybe it's worth 9 or 10 million one day, the next day it's worth 7 or 8 million, and so you can see already there's probably at least a 20% difference in value today than there was then, but we're still borrowing money at 6.25. And in commercial, I think you said residential is more like 6.5, 6.75 somewhere. Yeah. So residential is actually higher than commercial is right now. But if the Fed comes in and starts lowering rates over the next 24 months, that's going to drop by 2.5%. So if we're already in the 6 range, we're going to drop back down into the 4s eventually. I mean, I think it's going to probably go to the 5s for a year or two. I bet you're going to see 4s by 2026.
Wow.
So now how does that affect cap rate? Because if I'm buying this deal and I can buy it at a 5 cap and I can borrow money at 4, I got a deal. Mm-hmm. But if I'm buying it today on a 6% interest rate, every buyer on the planet wants at least neutral leverage. So it's a 6 cap. And the difference on an asset that size, think about it. A cap rate is pretty simple. So if you take a 5% cap and you add 1%, that's about 20% in value, mm-hmm. right? Because 1 is about 20% of 5, and you add that 1 to the. I don't have a deviation in here, but so you
also,
go.
I don't think
so. From a 5 to a 6, if something underwrites at a $10 million price, and you go to a 6 cap, you go from a 5 up to a 6. That $10 million property becomes an $8 million property. 1 percentage point is $2 million. So to a buyer, what does this mean? If you're a basis buyer, you're trying to get in deals. Even if you're trying to be creative, you're trying to get the seller. There's more seller motivation in today's market than there ever has been to be creative with you, to carry a contract, to lower their price, to do something, because we know that deals aren't. They're just there. There are some deals trading, but there are not that many deals trading. So I think just overall, I feel positive. I feel like, from a brokerage standpoint, I feel like we're all going to be doing a lot more business, and I think it's already starting to happen. And I think that just from a deal standpoint, buyers and sellers have had a long enough time to adjust to what's happening. And if you've got debt coming due, or you're excited about that next deal and you got to sell something, we're taking loans that are higher rates than what we're coming out of, because it's time. It's time to refinance. It's time to recapitalize. And before it was like, it felt like somebody was punching us in the gut to go from 4 to 6. And now we're like, yeah, you go from 4 to 6 because that's the interest. At least it's not 7 or 8, right?
Mm-hmm.
And so you just do it because that's what we do. Like, we're in the business. You can't just stop because rates go up. So I think that we will get some relief in the chokehold that the Fed has had on our industry. Will start to slowly and gradually be released. And I think that you'll start to see more deal volume. Plus, think of all the pinned up demand, especially in your 1 to 4 unit. Like, think of all the people that buy a house because they want to live over there or in that town or next to that school, or they want a 2-story, or they need another bedroom or whatever. Like, these are all the reasons that once you own a home, now you're stuck there, and the livability of that changes. And so people buy homes for a much different reason than they buy commercial real estate. And so those sorts of things are changing. There's death and divorce and all the reasons why people, move around. Think of the people who normally would have moved around the last couple of years who haven't. There's going to be a flood of activity. In terms of competition on a broker standpoint, I know on the residential brokerage side, I think 40+% of all the brokers nationwide, I read something, either didn't renew their realtor thing, or they drop their license or whatever. They'll come back probably, but there's a ton of people getting out of our industry. I don't think anybody really talks about how hard this has been the last 2 years. Like, if you've survived it, I mean, it was a crash. Nobody talked about it being a crash, and nobody was crying the blues. But I mean, you start to see some stuff on Facebook today where you see a real estate broker that goes like, hey guys, I just want to be vulnerable here. Like, I haven't closed a deal in a while, and I'm looking for a job, or who's got something, or I had 2 deals lined up to close, and they both fell apart, and I don't know how I'm going to make it. Like, you're starting to see more and more of this, where brokers that were running fat and driving G-Wagons a couple of years ago are going like, hey guys, it's
hard.
I mean, we were all hoping it was going to come back by now, and it just hasn't happened. It's coming. It's soon. It's happening. I think it's thawing out. We're seeing signs of that as we speak.
Man, you could really do this whole podcast by yourself. All right, let's wrap it up.
You want me to?
I felt
just
like
put me in a room.
I was thinking a lot of thoughts. I felt like I was talking.
I just talk until Trevor has to pee, and then we turn the mics off.
And speaking of that, I gotta go.
It's about
that. So this episode was brought to you by Vesta Solutions. Trevor and Dane run a company. These guys are doing what I always was hoping that we would have at SMI. So they're part of the SMI brokerage, but they're out helping people get into entry-level investment properties and scaling their portfolios.
So we help people build and scale real estate portfolios, whether you're starting out or you already own a bunch of properties and you're figuring out how to grow a little faster, a little larger. We help all investors.
So we're talking about big deals, and we're deal junkies, and you guys are listening to us, and you're excited and you want to do deals. You got to start somewhere, and that place to start is by calling Trevor and Dane and getting going, and they'll give you the blueprint for how to get going on this.
Trevor, do you have an easy way to find yourself? And also, I think Avery can probably put a link in the description.
Yeah, you can check us out on Instagram or Facebook, Vesta Solutions, LLC. You'll find us there. We put out free content, free classes, teaching you guys exactly how we buy deals. We share insights to all these deals and just try to give you a bunch of free information.
You included the LLC on the, was Vesta Solutions taken?
I don't know. I don't know how to use all that stuff.
You don't want to throw out a email or anything like that? They can email you?
Email me at trevor@vestasolutions.net.
All right, Vesta Solutions. This episode is brought to you by. All right. Thanks for joining us. We can't wait to see you next time.